Let's now go to one of Australia's leading investment managers, Roger Montgomery from Montgomery Investment Management. And Roger, can we just start with, the market and the way in which it responded today and even in recent times to the talk about the rising interest rates?
Can I give myself a pat on the back, Roscoe, and just say we own Alliance? So we're really happy with the Qantas bid. That's worked out really well for us. It was one of our top 10 holdings. I think the market is going to remain volatile and difficult to predict on a day-to-day basis simply because it is really, really difficult to discern what earnings growth is going to be for a lot of companies. Remember, a lot of companies have benefited from what we call the COVID pull-through. So there's a lot of COVID-related demand that was brought forward. Think second-hand cars and houses. And so businesses are really finding it difficult themselves to forecast what earnings are going to be. And why earnings are so important, more important than ever before, is because we've had this massive compression of PE in response to interest rates going up, particularly bond rates. Not so much the short end, but bond rates rising. So we've seen bond rates in the US, for example, just since October up about 142% in terms of the change in rates. And that has a huge compressing input or impact on PEs. So now those PEs are lower. You've got to find the companies that are growing their earnings so that even if the PE stays the same, you'll get a decent return.
OK, I want to unpack that because there's two aspects of this. One is technology shares. Ed just said a lot of tech shares, they were much stronger.
Yes.
And that's because, again, the interest rates in America were not rising as fast as some.
It's curious, isn't it?
It's curious.
They're going up, they keep going up.
We didn't hit you as hard as we thought we were going to hit you. It's a little bit softer, but we still hit you.
Yeah.
Anyway, but that's one thing, because the higher that interest rates go, the more that the future values of those business comes down.
Exactly.
That's the future. And especially if you're not making money, that becomes more vital.
So there's two things that happen. Number one, what you're talking about, the present value of future dollars is lower when interest rates go up. So interest rates act like gravity on the present value of future dollars. The higher interest rates go, the greater the gravitational impact. And that's true not just of shares, but property, art, any asset, really, any asset at all. And then the second thing that happens is that we get, as I mentioned, this compression in PE ratio. So if you take the bond rate and you add something called the equity market risk premium, add those two things together, that becomes the denominator, and 1 divided by that number is your equilibrium PE. That's gone from about 20 down to about 15 since October last year. And as a consequence, and markets are very efficient, that's precisely what the ASX 200's PE has done.
OK, so I want to jump in there again, because the other aspect of this right now, and you see this because companies are disappointing because their costs are rising because of the inflation.
Sure.
Because wages are rising, which the Reserve Bank didn't believe, but they were. Costs are rising. So therefore, if you can't pass on those costs, then you get stuck if there's a lot of competition in your industry.
Exactly.
And so this is why you've got to be very selective, I'd imagine, in picking the companies that can pass on those costs through to customers.
So that's relatively easy to do, finding the companies that have pricing power or that have inelastic demand for their products. But then what's happening is because of that COVID pull-through that I talked about earlier, they're slowing their sales growth. So you think that, yes, this is a very high-quality company, capital light, high rate of return on equity, little or no debt, dominant in its space, think Amazon, for example, and yet they come out and they say sales are slowing. So they get hammered anyway. So it's really, really difficult at the moment to discern earnings growth and sales growth.
Which is the reason why we see companies like, say, Booktopia yesterday, great company in principle, great, sort of, if you like, uptick in terms of the growth of the shareholders' funds. But then it disappoints because of costs and gets hammered by the market immediately. So anything that basically disappoints today is going to get slaughtered by the markets. We saw that again today that Ed was talking about.
And though, that on the other side of this, Ross, interest rate rises let me say this. Interest rate rises will continue even after inflation has peaked, because central banks will want to normalise their interest rate and give themselves some buffer if there's another crisis or a recession.
OK, so did you hear Jim Chalmers yesterday, the Shadow Treasurer, talking about the whole fact that you suddenly had a situation where rising interest rates means the economy must be crooked? So what do you think about this? Because I normally thought if rising interest rates were there, it was because the economy was flying at the time.
The economy is flying. So, Jim Chalmers, he's taken a book out of Donald Trump's campaign idea. A simple lie is more memorable than a complicated truth. And so what he's doing is he's saying the Prime Minister, Scott Morrison, takes credit when times are good, but won't take any responsibility when times are tough. And I'm asking, hang on, times are tough. We've got record high house prices. We've got record low unemployment. We've got record savings. We've had historically low interest rates, so people have been able to borrow money and make money. We've got a fantastic incentives tax-wise. What tough times is he referring to? You know, I think it's really easy just to try and throw a lot of stuff at the government, who, by the way, navigated us with aplomb through COVID. All around the world, countries supported their constituents and their economies through fiscal spending. Our government does exactly the same thing. And the Labor Party did it as well under Kevin Rudd. And so how is that irresponsible or reckless? It isn't. I think they've been doing a really great job. And I wanted to throw my wine glass at the TV last night when I saw Jim Chalmers saying that, because not a lot of it is true.
Well, it depends on which side of politics and that debate you're on at that time.
Indeed.
Roger Montgomery from Montgomery Investment Management. Always good to have in the program. Many thanks for your time today.
Thanks, Ross.